So, how to prepare for a stock market crash? So, you must be hearing in the news everywhere, people are talking about a stock market crash in 2018. But I mean, if the general public is aware about it or is anticipating it, then it's probably not going to happen. As a general rule, the stock market will crash when we least expect it. You'll always have a few exceptions that will probably predict it, but you'll never know exactly which year the stock market will crash. But what you do know that eventually it will, because for the past 100 years it's crashed 5 times. So, and we don't even it seems like we don't learn from our mistakes, and we just keep doing different mistakes or new mistakes, causing the stock market to crash. That's why sometimes I feel like the stock market is a game, because it doesn't make sense. You would think that we know what exactly crashes the market, so we would avoid it, yet it happens again. So for sure it's gonna crash, but nobody knows when. And especially if we're talking about it right now and that we're saying it's gonna happen in 2018, then it's most likely not gonna happen in 2018. So how do you prepare for it? So you want to invest on the stock market, but at the same time you're afraid because you don't know when the stock market's gonna crash, so you're afraid to buy stocks, and then everything you bought just crashes. So you can't just wait for the market to crash to buy in, even because you know that whenever the stock market crashes, a year or 2 years later it recovers, especially if you buy companies that don't go bankrupt, or they're not going to disappear in a stock market crash. I mean, if you look at 2008, 2009, you could see that the lowest point was March 2009, and it took about 3 years to recover, or to go back to high 2007. To go back to the numbers of 2007, it took about 2-3 years for the stock market to recover, and then a few years later, it just went even over past 2008, 2007 numbers. So here's how I would prepare for a stock market crash. I'm not going to stop investing in the stock market and just wait for the right time to buy. I want my current cash to grow. So what I would do to prepare for a potential stock market crash is just to always make sure there's enough liquidity to buy some more stocks in case of a stock market crash. Because a crash, I see it as an opportunity. I'm not gonna panic and sell what I currently own, especially if I own stocks, blue chip stocks, like stocks that won't disappear, stocks with huge market cap like Apple and Google, stocks that are not gonna disappear during a market crash. Their price will go down for sure, so that's gonna make it a very attractive price to buy it at. So I would prepare for a stock market crash by making sure I have enough liquidity to buy some stocks. I would say maybe keep 20% of my portfolio liquid or in cash. So let's say I own stocks and their price goes down drastically during a crash. Well, I'm still collecting dividends from these stocks while they're in the lows. So obviously I'm not buying and selling. Like I won't be making capital gains from buying and selling the stocks, but I'll be making dividends from holding the stocks. And if I have enough liquidity, if I have, let's say, 20% of my portfolio in cash, I can buy some more stocks during these attractive prices, and then wait for the market to recover, as it always does, maybe a year or two, and easily double my investment. So you might say, if I always leave 20% available in cash, then that 20% is not working for me. So I'm not really growing 20% of my portfolio. It just stays idle. So my strategy is, since I never put, let's say I have $30,000 in my portfolio, I'm never going to buy one stock with $30,000. Let's say I decide that I'm only going to buy 20 different things with my portfolio. So I'm going to take 30,000 divided by 20, which is about 1,500. So I'm always every purchase I make will be with $1,500. And I only buy stocks when the price is right, in my opinion. So it will happen, whether I want it or not, that I'm going to have some leftover cash because I didn't find the right price yet. And maybe when I find something and I buy a stock, I'm going to sell something else. So then another 1,500 becomes available to me, or a little bit more than 1,500. So it's rare that I'm going to have 100% of my portfolio invested in equities. Because I buy and sell, often. At a given moment, if you take a picture of my portfolio at a given moment, there will be available cash. So that's how I would prepare for a stock market crash, just to make sure I have enough liquidity to take advantage of the new low prices. I would not sell what I currently own, of course. I wouldn't panic, but I'd make sure that I buy stocks with dividends, so that while I'm holding the stocks and waiting a little bit longer for the stocks to go back up, I'm making some sort of money from my holdings in dividends. Now, for those who buy and hold long term, 5 or 10 years, that could cause an issue because, for example, let's say you bought something in the year 2000 and you plan on holding long term. So let's say you invest in the index fund, which is comprised of a group of stocks. So S&P 500 is the top 500 stocks. So let's say you would have bought the index at 2000 and you're holding long term. Well, guess what? For the next 3 years, you're losing money. But you don't care. Your strategy is to hold long term. Maybe you'll buy some more in 2003 at about, say it dropped all the way down to 900. So you'll buy some more in 2003, and then come 2007. So what you bought in 2000, you haven't gained anything for 7 years from it, because 7 years later, it's at the same price. What you bought in 2003, you will have profited from it, because it would have gained almost, so what you bought at 900 reached 1500. So almost like 80% gain from 2003 to 2007. But then all of a sudden in 2009, market crashes. So basically everything you bought before and any gain you made, you just lost in less than a year. So the past 9 years were completely wasted because you're a long-term investor. Even what you bought in 2003 is worth less right now in 2009. But let's say you ignore all that and you still hold on to your investments, and you're in 2018 right now, so you bought in 2000 and you held on to it till 2018, and you buy every year. So you've bought in 2000, 2001, 2002, 2003. But as you can see, from 2000 to 2012, you're pretty much buying at the same price at around 1400, except if you bought in 2009, of course. And then come 2018, the index is at 2800. So let's see what kind of return that gives you. If you had bought the index fund in the year 2000, so you're at 2800. So you're at 2800 divided by 1400. So that's 100%. So you would have doubled your money in 18 years. So 100% divided by 18. So you would have made 5.5% average per year. So that's not a bad return, but you can definitely do better if you buy individual stocks and if you take advantage of short-term fluctuations. For example, if we just look at 2015 or 2016 at a 1-year interval, if you would have bought something at 1800 and then sold it at 2000, you would have made 11% in less than a year. So that's already more than the 5% average that you made in 18 years. And then you just repeat the process. So there's always ups and downs throughout the year, and I like to benefit from these ups and downs while focusing and investing only in stocks that are not going to disappear, because in case I did not estimate the right price to buy in, well, while I'm waiting, I'm collecting dividends and I'm confident that the stock is going to go up because I bought a big name company, and the general direction of a stock is to go up. You've got people behind a company, their sole purpose is to make sure that the stock price goes up. So competent people who have turned a company into $1 billion company, and their general direction is to make the stock go up. But it does happen, of course. There's obstacles on the way or hiccups that will make the stock go down. So that's a perfect buy opportunity, because there's people working hard in the background that are going to make the stock go back up. So that's why I see drops in the stock price as buying opportunity, and I let them worry about how they're gonna make it go up. I don't even have to find out how. I'm just confident that they will, because of the company's history and the company's competitive advantage in the market, and I'm able to see the product or the service that they're offering in the market, and I can see for myself that they're not going anywhere. So by buying and selling more on a short-term basis, you give yourself a better chance. You give yourself a better chance of making sure you have enough liquidity when the time comes to to buy more stocks, because you're not always holding stuff. You're not always holding stocks because you're buying and selling. Eventually, when you sell, you have cash available, and when you sell, you don't buy right. When you sell, you don't buy right away. You wait until something else comes along. You wait for a better opportunity, and then you buy. So that's how I would prepare for a stock market crash, is just to continue investing on a short-term basis, so that I always have enough liquidity, and also make sure that I have enough liquidity in my general portfolio, so that if stock market crashes, then I take advantage of the low prices and buy some more stocks, while remaining in the category of stocks that are not going to disappear. And by not having a greedy strategy, I aim to make between 10 and 20% per year. Obviously, if you want to make 50% or 100% per year, then you're going to have to look at riskier stocks or penny stocks. You're going to have to maybe day trade, which is much riskier. But because because my goal is reasonable, 10 to 20% per year, then I'm able to apply my strategy. So let's look at Ford, for example, a stock that I bought at 10.91 initially back in, don't remember, probably back in January. And then I sold at 11.9. So that I sold in June. So bought in January at 10.91, sold in June. So it's a good thing I sold, because I was happy with 9% or 10% gain. And just my luck, the stock dropped back below 11. So back below the price that I initially bought it at. So if I didn't sell, I would have missed out on 10% profit right here. And then I would be at the same price that I bought it at initially after 6 or 7 months. But at least now I benefited from the 10% gain. And I bought back some more at 10.95, hopefully to benefit again. So I bought back some more at 10.95, hopefully to benefit again when it goes back up. If it doesn't go up, if it continues to go a bit lower, I can buy some more, or I can just wait and I'm collecting dividends while I'm waiting. So I understand that people like to invest long term, hold the stocks long term. So they bought it, let's say at 11, they're comfortable at that price, and they'll just wait 5 years or 10 years, and they're confident that the stock will reach probably, let's say, $20 in 10 years. But while it reaches $20 in 10 years, it's going to go up several times, go up and down several times in those 10 years. So why not benefit as much as you can, of course, from the short-term fluctuations? Because if you divide 20 by, let's say you bought it at 11, that's 81% gain in 10 years. So 81 divided by 12 is about 6%. Sorry, 82 divided by how many years? 10 years. That's about 8% per year, which is also not bad. Plus you're collecting dividends, so it's probably, and with Ford you're probably collecting 5, so it's about 13% per year. But that's if Ford reaches 20 in 10 years. It might not reach 20 in 10 years. It might go through a crash maybe in 4 or 5 years, and it might not reach 20 in 10 years. So really, depending on the stocks you buy, I mean, buying and holding long term is definitely not a bad strategy. I mean, Warren Buffett recommends it, of course, so it's definitely not a bad strategy, because for sure you're gonna be making more than if you just leave your money at the bank, or if you invest your money in mutual funds at the bank. So holding long term is not a bad strategy either, but might not be the most optimal strategy, because you could take advantage of short-term fluctuations and still make between 10 and 20% per year. And also to make sure it gives you a better chance to have liquidity when the market crashes, so that you can take advantage of the new prices. And there's a strategy of holding long-term, taking the dividends and buying back. But the problem I see with that is when you collect the dividends, the price of the stock might not be attractive for you to buy some more of. And depending on the amount of dividends you get, if you start off with $1,000 and you make 5% dividends per year, $50 is not enough to buy a stock. So you're not doing much with $50. But if you buy and sell, let's say you buy a stock, you put in $1,000 in a stock and you sell and you make 10% or even 20%. So that $1,000 becomes $1,200. You take that $1,200 and you buy something else and you make another 10%, let's say. Well, then you just made 10% on your capital, but also on the 20% profit that you made initially. So that's compound interest. I'm gonna make another video about compound interest, because it's definitely powerful and there's a lot to say about it. But so that's why I find it more beneficial to trade short term, so you can also take advantage of compound interest. Let's look at the index again. So the only way really you would have benefited from from a long-term investment is really right after a crash. So if you had bought in 2009 at, let's say, 900, and then in 2018 you're at 2800, you would have tripled your money. So you would have made an average of 23% return if you had bought in 2009. But of course, you won't have just bought in 2009. You would have bought before that and after that. And you don't know what's going to happen after 2018. Maybe 3 years later or 5 years later, market crashes back to, let's say, 1500. If you're just investing long term and you're never confirming your profits, you're never selling to confirm your profits or take in your profits, you're just losing all the gains that you've made for a very long time. And the gains that you see here, let's say in the 1980s, you're at 120, and 2000, so 20 years later, we're at 1464. We're not going to see gains like that anymore, that's for sure. We're not going to see that type of growth. In this scenario, holding long term is definitely the right strategy. But where we are today, we're not going to see here. Let's look at what kind of return you would have gotten in 1980 from if you had held for 20 years from 1980 2000. So it was at 1500 and you bought at 120. So 1500 divided by 120 minus 1 times 100 divided by 20 years. So you would have made 57% return every year since if you had bought in 1980 and sold and kept it for until 2000. But this spike here in 20 years, it's not going to happen again. If you had kept it until 2018, let's say, so 2800 divided by 120 would have made 23 times your money minus 1, so about 38 years. So you also would have made 58%. So you see what I mean? So from 1980 to 2000, you would have made about 53% average per year. But if you had waited an extra 18 years, you would have made an average of 58. So those extra 18 years didn't do much. So holding long term used to work because of the sudden spike we got in the 80s and 90s. But right now, where we are, holding long term is not really gonna work, in my opinion. I'm not gonna hold long term. I'm gonna focus on big name companies and try to trade them on a short term basis, like 3 months or 6 months, and just make sure I have enough liquidity to buy more stocks when they drop, or even better, when they crash. So yeah, I think that's all I have to say for how to prepare for a stock market crash. You don't have to fear it. On the contrary, you should make sure you have enough liquidity to buy some more stocks. And if you only invest and deal with big name companies, you have nothing to worry about. Give yourself 2 years and the stock market will recover. And while you're waiting, you're collecting dividends. So yeah, if you have any questions, leave them in the comments below. If you don't agree with what I said, please also leave them in the comments below. I like discussing these things. I'm open to different ideas also. Thanks for watching.